The home listings were frozen, rents were jumping month to month, and anyone with a 3% mortgage wouldn't move. Real estate agents kept saying, "Wait for the crash." It never came. This wasn't an accident. Over the last 15 years, housing was optimized for asset inflation, not shelter. The policies enacted by our financial and political leaders made buying a house feel impossible. In this video, we'll reveal the three main causes of the current housing affordability crisis by order of magnitude. The result of these policies is lost mobility, widening inequality, and a generation priced out. To understand how things got this bad, let's first start with the tax code. From the homebuyer's perspective, this policy felt personal. You'd get pre-approved, tour 3 places, write a clean offer, and lose to cash. It kept happening because the tax code tilted the table toward the bidder who didn't plan to live there. When financial policy treats housing as an investment vehicle, the question is simple. Who can outbid whom? Households carry W-2 income, down payments, and mortgage underwriting. Institutions carry depreciation schedules, interest deductions, and exit strategies. That math decides outcomes, one closing at a time. After 2008, home foreclosures spilled into the market. Private equity funds and REITs built platforms to buy in bulk, renovate quickly, and hold as rentals. The tax code made it advantageous. You can deduct mortgage interest and operating cost. You depreciate the structure over years, even as the land depreciates. You can use like-kind exchanges to roll gains forward without immediate taxes. When it's time to sell, capital gains rates often beat ordinary income rates. Layer in cheap financing when interest rates were low, and the model scales. The effects were striking. By the end of 2023, the 10 largest institutional owners held more than 430,000 single-family rentals in the United States. Total corporate holdings approached 600,000. Nationally, that's a small share, roughly 3 to 4% of single-family homes. But the averages hide the pressure points. In Metro Atlanta, a few firms held around 11% of single-family rentals. In Mecklenburg County, North Carolina, corporate ownership climbed from about 10% in 2010 to roughly 26% by 2023. In parts of New Jersey, nearly 1 in 5 small properties shifted to corporate hands over a decade. What nobody in the bidding war thinks about are all the corporate levers. Institutional buyers can waive inspections, close fast, and accept thinner yields up front because tax treatment cushions returns and scale lowers cost. If they miss one house, they buy the next 10. A young family gets one shot per weekend. Picture this. A couple walks out of a closing office in tears. They stretched to their limit, locked in a rate, and matched the asking price. However, the seller took a same-day cash offer from a private equity fund. 2% higher, no contingencies. 15-day close. Multiply that by thousands of transactions. Each one converts a potential owner-occupied home into a rental. The for sale inventory shrinks, the rent roll grows. Impact shows up in 2 places. First, fewer entry-level listings. That raises the floor under prices because the cheapest rung disappears. Second, rent power concentrates in neighborhoods where corporate ownership clusters. Software programs set renewal prices. Fees standardize. Tenants move less because moving is expensive in a tight market. Even when rates rise and debt costs go up, the tax code still softens the blow for investors compared to households. The incentives don't flip, they just narrow. There's debate about solutions. Some lawmakers have proposed caps on the number of homes a single entity can own. Others target the tax perks, tightening depreciation rules or limiting interest deductibility for large portfolios. Supporters of corporate landlords point to professional management and renovations of distressed stock. Critics counter that the same tools that made bulk rescue possible also make bulk extraction easy. While the fight plays out, something even more basic blocks change. Even if every corporate investor stepped aside, many cities still made new homes illegal in many neighborhoods, drastically limiting supply, the second most important factor in housing affordability. If you can't build new homes where the jobs are, house prices climb. Scarcity protects incumbent wealth. It pushes everyone else to the fringes or into overcrowded rentals. This isn't geography, it's law. In the US and Canada, local zoning codes locked huge shares of residential land into one use: detached single-family homes. In some cities, 3/4 of residential land allows just 1 unit per lot. Duplexes, triplexes, small apartments, off the table by default. Demand concentrates, but supply can't flex. Japan took a different path. Japanese law sets 12 to 13 broad real estate zones, and they're cumulative. This means higher zoning categories allow the ability to build everything within the lower ones. That means apartments are permitted in many residential zones, and small businesses can operate under clear rules. Instead of separating real estate uses, Japan leans on form factor, floor area ratios, building coverage, and slant plane rules that control shadows and height. The question is less, what are you, and more, how big and how do you fit into the overall area? For example, in Tokyo, when demand rises in a neighborhood, you might see mid-rise infill on narrow streets, corner bakeries under walk-ups, and small shops steps from homes. Supply responds where people want to live. In North America, when demand hits a single-family district, the response is renovation and bidding wars, not more housing options. Zoning policy matters. A flexible system creates optionality. Developers and small builders can add units without bespoke rezonings and lawsuits. Homeowners can split lots or add small apartments. Over time, a city can grow internally. When central banks push rates down, prices don't spike as hard because new units can meet some of that demand. When rates rise, mobility doesn't freeze as completely because there are more housing options. Recent history tells the story. Inelastic housing supply in North America amplified quantitative easing era price jumps and preserved them even during interest rate increases. Meanwhile, Japan's big cities saw far more construction and more stable price dynamics over decades, with local exceptions where districts choose to restrict. When local politicians listen to NIMBY coalitions defending zoning rules to guard property values and neighborhood character, they are making a conscious decision to limit supply and drive prices higher. The final and most important policy factor affecting house prices involves the opposite of supply: demand. To understand more, we need to go back to 2008. The housing crash threatened the entire financial system. The Federal Reserve rolled out a new playbook, quantitative easing. It would buy vast amounts of treasuries and, crucially, mortgage-backed securities. The goal was simple: push down borrowing costs, stabilize banks, and keep credit flowing. The plan worked, but with a twist. When you target mortgage rates, you target the price of houses. In the 2010s, mortgages got cheaper, refinancing surged, and prices recovered. Then 2020 hit. The pandemic froze the economy. The Fed bought at unprecedented scale, about $1.33 trillion in mortgage-backed securities from 2020 to 2022. 30-year rates fell to levels most Americans had never seen. Demand roared back. Supply didn't. With interest rates collapsing, households could suddenly afford larger loans for the same monthly payment. Bidding wars returned. Appraisals chased offers. Homeowners watched their equity grow by trillions. Roughly $12 trillion in added housing wealth across the boom. The wealth effect spilled into spending. It felt like a recovery because for owners, it was. Meanwhile, renters and first-time buyers were on the outside looking in. Wages didn't rise like asset prices. Entry-level buyers found themselves outbid by people refinancing into lower payments or by investors whose financing costs were now rock bottom. Metro areas with strong job growth saw the fastest appreciation. Depressed regions lagged. The Fed's policy saved the financial system but created collateral damage. What nobody focused on at the time was the exit. You can push interest rates down fast, pulling them back up is messy. In 2022, inflation forced the Fed to hike quickly. Mortgage rates doubled in months. Everyone expected house prices to fall. Instead, transactions froze. People who locked in a 2.8% mortgage in 2020 weren't going to trade it for 7%. They stayed put. The lock-in effect removed millions of potential listings from the market. According to federal housing data, from mid-2022 to mid-2024, rate lock-in meant roughly 1.7 million fewer home sales, and counterintuitively, a small net increase in home prices despite the higher rates. This was the moment that everything changed. The market didn't clear through falling prices, it cleared through falling activity. Fewer listings, fewer closings. Rents climbed as would-be buyers stayed renting longer. The price stickiness wasn't magic, it was policy arithmetic. Starved supply with lock-in, and even weaker retail demand doesn't push prices down much. The same policy that prevented a deeper financial bust entrenched housing scarcity and higher prices. 3 policy levers: pull tax strings for corporate investors, block supply with zoning, and increase demand with cheap money. All have the same outcome of pushing housing prices higher and restricting household mobility by design. Single-family homes, once the American dream, have been turned into financial and political policy tools. What was the moment you realized the system was stacked against you? Tell us in the comments. What cash offer did you lose out to? How high was your rent hike? Share your story in the comments so we can show the full scale of this issue.